Get ready for cargo shots from the Strat Times, presented by Hactl. Here's a weekly roundup of the latest air freight and logistics news.
Boeing hits a key 777-8F milestone. FedEx posts strong results despite a $120 million setback. And Zipline's $800 million push into next-gen logistics. What's next for air cargo? Stay with us as we unpack the biggest developments that shaped global air cargo this week. I am Nikita Sebastian and this is Cargo Shots presented by Hactl. Boeing has reached a key milestone in the 777-8 freighter program, completing the wing body joint for the first aircraft at its Everett facility. This integrates the fuselage with composite wings, marking a crucial step as the program transitions from structural assembly to systems installation and overall aircraft integration. The company began production in July 2025, starting with wing spare fabrication. It has since progressed to installing systems and wiring in the fuselage. The program has secured 68 orders led by Qatar Airways, with additional commitments from major global airlines. Designed to replace aging 747-400 freighters, the 777-8F will match payload and range while delivering 30% better fuel efficiency and emissions, and 25% lower operating costs. Entry into service is targeted for 2028 as Boeing advances assembly and testing while managing early-stage production challenges. AerCap has signed lease agreements with Ethiopian Airlines for two Boeing 777-300ER SF converted freighters, marking the aircraft's debut in Africa. Deliveries are scheduled for the second quarter of 2028, positioning Ethiopian Airlines as the first operator of this advanced wide-body freighter on the continent, and expanding its long-haul cargo capabilities. The 777-300ER SF, known as the Big Twin, offers around 25% more capacity than smaller twin-engine freighters, improving efficiency and lowering operating costs. AerCap highlighted the aircraft's ability to support growing cargo demand, while strengthening its global leasing portfolio and long-standing partnership with Ethiopian Airlines across international markets. Ethiopian Airlines said the deal will enhance cargo capacity, boost regional trade, and support its expansion strategy. The agreement reinforces its position as a leading cargo carrier connecting Africa to global markets. The move also signals increasing adoption of modern, fuel-efficient freighter aircraft to meet rising air freight demand. FedEx reported strong third-quarter FY26 results, with revenue rising 8% to $24 billion, adjusted operating income reaching $1.62 billion, and earnings per share increasing 16% to $5.25. Growth was driven by FedEx Express performance, cost discipline, and network optimization, prompting the company to raise its full-year earnings and revenue outlook. Despite solid financials, FedEx faced a $120 million hit from the grounding of its MD-11 fleet, following an FAA directive after a 2025 safety incident. The disruption increased costs and reduced capacity during peak season, with an additional $55 million impact expected in Q4 before operations gradually resume. FedEx continues advancing transformation initiatives, including Network 2.0, targeting $2 billion in savings by 2027. It is also preparing to spin off its FedEx Freight unit in June 2026. Strong international performance and operational resilience have helped offset challenges, positioning the company for sustained growth despite ongoing fleet and industry pressures. Global air cargo rates rose sharply in the week from March 9 to 15, climbing 10% week-on-week to $2.67 per kilo, as Middle East disruptions constrained capacity. Market volatility, higher fuel costs, and rerouted networks drove the increase, with demand backlogs and uncertainty continuing to pressure global supply chains and pricing dynamics. Spot rates surged 12% to $3.19 per kilo, with the steepest gains from Middle East and South Asia origins. Volumes rebounded from prior declines, but capacity remains limited. but Gulf origin shipments and rates rose significantly week on week, though volumes are still well below pre-conflict levels despite partial recovery. Rising jet fuel prices and operational restrictions, including limited flights in the UAE, are further inflating costs. Key trade lanes to Europe and the US recorded strong rate increases. While Asia-Pacific volumes are recovering post-Lunar New Year, global tonnages remain below last year, highlighting ongoing instability. Zipline has raised an additional $200 million, taking its Series H funding round to over $800 million after strong investor demand. The round, previously led by major global investors, values the autonomous drone delivery company at $7.6 billion and will support expansion across the United States and international markets. The company plans to use the funds to scale operations, expand partnerships, and grow its platform rapidly. Delivery volumes are increasing, with higher order frequency and basket sizes. Zipline also aims to double the number of brands on its app within weeks, enabled by faster onboarding technology and improved logistics capabilities. It is also expanding globally, including a new national-scale contract in Rwanda to deploy its Platform 2 system and strengthen healthcare logistics. The company highlighted its operational resilience in harsh weather and continued growth across sectors, positioning itself as a leader in autonomous, sustainable, and scalable delivery solutions. Hong Kong Air Cargo Terminals Limited has deployed 100% closed-loop recycled plastic sheets across its cargo handling operations, marking a first for the global air cargo terminal sector. The initiative eliminates the use of virgin plastic, advancing the company's shift towards circular material use in logistics and ground handling processes. Developed with the Nano and Advanced Materials Institute, the sheets are produced entirely from post-consumer plastic waste generated within Hactl's own operations. The closed-loop system recovers, processes, and reuses materials, creating a self-sustaining supply chain solution designed to reduce waste and improve recycling efficiency across cargo handling activities. Hactl said the move will cut demand for virgin plastic, particularly in aircraft pallet wrapping, and could serve as a model for wider industry adoption. The initiative reflects growing pressure on the air cargo sector to address environmental impacts beyond emissions, focusing on sustainable materials and waste management practices. Thank you for joining us on this week's Cargo Shots. Stay updated by hitting the subscribe button on our YouTube channel and visiting www.stattimes.com for daily news updates. We will be back next week with a new episode of Cargo Shots featuring more interesting stories.
You've been watching Cargo Shots from the Strat Times, presented by Hactl. See you next week with more updates from the air cargo and logistics industry.